when it now comes to now setting up your payroll, for you to now do your payroll setup and calculation, what this means is that you know what your annual salary is, then you know what your statutory deductions are, then you can be able to calculate and do a net calculation. So you have your gross pay, statutory deductions, either statutory or personal deductions, then you can be able to get your net pay itself. So in trying to do that, you need to understand your payee. Very critical is that in trying to get your pay as you earn, it's a withholding tax on income payments to employees, and it's backed by PICTA 2011. Now, what are the basic features that you should recognize? Number one is the definition of gross emolument. I don't want to get into technicality, but when it comes to income as defined by PICTA, it says that wages, salaries, allowances, including benefit in kind. So benefit in kind is not exempted from tax deduction. Gratuity, bonuses, and other incomes derived solely by reason of employment is open to taxation. So you need to look at payee in two forms. One, every single salary of the employee is open to tax, but they have now created what we call tax relief. So if your salary is 1 million naira, there are tax relief elements that are given to you. You will now deduct the tax relief from the total salary to get what we call your taxable income, meaning the income that it is now open to taxation. So in terms of the taxable, the tax relief that are available, one is what we call your consolidated tax relief allowance, CRA. And that is composed of two parts. It has two parts to it. 200,000 or 1% of gross income, whichever is higher. Now, this particular part of the consolidated tax relief is often confused by most, even finance individuals make this confusion. They only deduct 200,000. They forget the second part that says 1% of gross income or whichever is higher. Now, in a situation whereby the salary of the employee is lower than 20 million naira, it will always be 200,000. But immediately the employee's salary is more than 20 million, 1% of 20 million of 21 million is already 210 million, which means in this scenario, rather than use 200,000, it will be 210,000. So that's why the 1% of gross is very critical, plus 20% of the gross income itself. Then other parts that are tax relief is your employer pension, your employee pension, which is 8% of basic housing and transport, is exempted. Your additional voluntary contribution is exempted. Your national housing fund is exempted. That's 2.5% of basic. If you have a life insurance, is also exempted as well. So we're going to get into our Excel in a bit. So this is the tax table which we're going to be working with. Once you have been able to deduct your tax relief from your taxable income, once you're able to deduct your tax relief from the total salary, then you get what we call your taxable income. Whatever amount is remaining will be subjected to the tax table of the first 300,000, 7%, the next 300,000. Each of these tax table, you can write a single if statement for each of them, and they will get you your annual tax. You don't need to disturb yourself. A single if statement solves this out for you. And it's also critical that the remittance of the tax must be made at the Internal Revenue Service of the state where the employee is resident.